Right, let's get into the first panel. Can I ask the first lot of panelists to come up onto the stage? Now, we're going to discuss managing risk through the cost of living crisis, and this session is in partnership with Lantern. So please welcome up onto the stage Emma Steely, who's Chief Executive of Freedom Finance, Anna Ruffley, who's Head of Insight and Engagement at the LSB, Cyril Saldashu, Chief Risk Officer at HSBC, Paul Heywood, Chief Data and Analytics Officer at Equifax, and Victoria Stubbs, Managing Director of Compliance at Barclays. Thank you very much indeed. If you'd like to take a seat. So, let's just get a quick sense of where you're all coming from on this key question of managing risk. And risk is very much back, not least because of everything we've just heard from Daniel, but also political instability and everything else. So tell us briefly who you are, what you do, and where you're coming from on the question of managing risk. And let's begin on the end with Anna.
Hi there, my name's Anna Ruffley. I'm from the Lending Standards Board. We're the primary self-regulatory body for the banking and lending industry. I head up the insight and engagement teams at the LSB, and so our focus is to really support our registered firms and the wider industry to achieve good outcomes for personal and business customers. And we're also responsible for the authorised push payment scam code, known as the CRM code.
Emma.
Yeah, good morning, everyone. Emma Steely, I'm the CEO of Freedom Finance. We're a digital lending marketplace, and so what we're focused on is about delivering personal credit solutions 24/7 for our customers. We've seen a huge increase in demand for credit. Actually, we've seen credit quality maintain, but we're seeing less offers to customers. So for us, we're very focused on deploying data intelligence and working more strategically with our lending partners to deliver better outcomes for the customers.
Paul.
Morning, everyone. So Paul Heywood, Chief Data and Analytics Officer for Equifax in the UK. Our role at the moment is one in terms of supporting our clients, our customers. We're in a very different period. The indicators and insights that our clients are trying to understand to preempt potential financial difficulty for consumers further down the road is a topic high on our agenda. So it's around innovating around data, innovating on solutions, and engaging with clients on potential remedies.
Cyril.
Cyril Saldashu, I'm the Chief Risk Officer for HSBC UK Retail Wealth and Private Bank. I think in terms of the focus, I think it's probably very much about being ahead of the curve, actually, as much as we can, actually. So through the pandemic, I think we saw changes we did not expect, actually. Every time I think something happened as a crisis, it just turns out to be very different from what we expect, actually. So it's really trying to understand, actually, through better early warning indicators, really going below the average, really understand what's happening at the customer level, actually. Identify those signs of stress, identify the pockets and everything, and try to be ahead of the curve, try to help the customers where we can, but really understand and model. And look at the range of things that could happen and could affect us and our customers.
And Victoria.
So I'm Victoria Stubbs. I'm a Managing Director in Compliance in Barclays UK. Previously worked in various risk roles. And what we're doing at Barclays, similar to Cyril, is really working at how we support our customers. This crisis is as much about conduct as it is about credit risk, and you've got the two very much coming together. So it's about making sure that we can, again, identify customers who have low financial well-being, who are experiencing stress, giving them early indications, being more proactive than, having talked about 2009 before, there is a level of proactivity now that didn't exist in 2009, and making sure that as lenders we are reaching out to our customers, we're giving them information, and we're being proactive in supporting them as we go through the crisis.
Great, thank you very much. Now, can I just remind you, could we have the Slido QR code up on the big screen, just in case there are people who haven't yet joined it? Just if you point your camera phone at that, that will take you through to Slido, and please do send any questions or comments on the Q&A section of that Slido app, and I'll try and work them in. But let's just start. There may not be a simple question to this, but the biggest risk to lenders right now, Cyril?
I think it's probably conduct, actually, as Vicky mentioned. I think credit, we will probably see some pressure at some point. Actually, we haven't seen too much so far, but we will see, and if only because of the slow impact of the increase in interest rates, especially on mortgage customers. But I think it's very much really understand what we can do to support our customers. I think because credit, I think we know how to manage this. I think we've done this for many crises already. But I think the bar, and rightly so, I think is being increased in terms of conduct and how we support our customers. So I think for me, that's really where we spend a lot of our time.
And the context for that, I suppose, is what? Changing regulation, greater expectation from politicians.
Yeah, I think in many ways, I think consumer duty, of course, I think which is coming in July this year, actually, which is quite a big deal. Actually, I think that's certainly top of the agenda. I think this is also, I think there's an expectation that I think we need to start to really reach out to our customers even before they get into difficulty. Try to give them the tools, the support they need or they deserve as well, actually. So the expectations are rising and rightly so, actually. So I think it's a whole range of things as well, actually.
Victoria?
Yeah, and I think it's partly regulatory, the drivers, partly also firms and customers expect different things from companies now. Consumers are significantly more aware as to how companies behave. They're making more proactive choices, whether it's on the environment and climate agenda, but also good conduct makes good business sense. It keeps customers with you. It will, if you can't compete on price, then you're starting to compete on service, and having good conduct, risk management, being proactive. So, for example, when we had the spike in mortgage rates after the trust budget late last year, we had customers remortgage at high rate. Actually, we then reduced our rates, so we proactively went out and said, you can move on to a lower rate, which is something back in 2009 the big banks weren't doing, but this time it was the right thing to do. It moved them appropriately. And as lenders, you're starting to say, what's the best thing we need to do for our customers?
Anna?
Well, what we're seeing and hearing in relation to the cost of living crisis is two almost diverse views. One is the state of absolute desperation of customers, first of all. And in the second side of things, particularly from lenders, that they've not seen the impact that they were expecting to see at this point from customers. And so I think I just want to link into both of your comments, which is from a regulatory perspective. Of course, we want to prevent harm for customers. And an area that we see more can be done in that space is preventing customers from falling into financial difficulty or trying to reduce the impact of that when it does. And there's particular spaces we can do that in. We see really good activity around that in the sales aspect, for example, and we see really good behaviour around in the collection space. But in that ongoing management, some of the things that you were talking about then, proactively reaching out to customers, we would like to see more done with the data that we have available, with other tools that we have available to us, to identify those customers who are on that trajectory to fall into difficulties, reach out to them, and try and halt that process a little bit, or at least raise their awareness and make them aware of the support that is available to them.
I mean, is responsibility for that? Is there a sense that that's going up?
I think that's fair to say, and again, linking back into your points, there is more expectations on banks and lenders. The consumer duty, for example, will do that. Our standards at the LSB for both personal and business customers are outcomes focused. We want to see those better outcomes achieved. But of course, customer expectations have also changed. And so I think that there is an opportunity for us to work better together, if you like, to make sure that those better outcomes can be achieved through open engagement from both sides.
Let me give you maybe a couple of examples, actually. I think it's just of what we've done, and there's plenty more we can and probably should do as well, actually. But on the back of what you said, actually, we've reached out to more than 5 million customers, actually. I think that we've identified could be in difficulty. We've set up a cost of living hub on our website, actually. I think there was a point where we were rated number 4, I think, on Google, I think, when you were looking for a cost of living. And it's all about self-help tools, actually, budgeting tools, actually checking what you're entitled to in terms of benefits. So actually, I think that's some of the things that we can do, actually. And we're starting to see the customers respond. Probably not as much as we would want, but we're starting to see a good level of response, actually.
I think those are really good examples. I think one of the key things we want to think about is we've got two examples there where you see things that are happening to customers and you reach out to them proactively, but you also know that there's that external environment, and you're saying, actually, here's some information for customers that they can also self-help with. And it's about thinking about the timing of when customers get information, because very often we provide it at a time when things are going horribly wrong, and it's quite difficult for them to take on that volume of information. And so we would definitely encourage our registered firms and others to consider, where can our customers gain easy access to information? So your website's bringing that forward proactively, referencing it through the training and awareness with our employees, letters, etc., and then those proactive campaigns that you've spoken about.
I mean, Victoria and Cyril, I mean, you know, the most popular question on there, what meaningful tools will you share with customers upon identifying early indicators of distress that can help?
So we do identify customers with low financial well-being. That number is growing but slowly and growing less quickly at the moment for looking at that population. So we will proactively reach out via email, telephone, as well as making sure that on the website we have a number of money management tools, budgeting tools. We will talk about the important things such as priority debt, so making sure that people are focusing on things like mortgage and council tax. You know, it's
and of those things, which ones work and which ones don't?
We're still creating the data. It's something that's relatively recent. I think we need to, different things work for different people. What we're trying to do is get them early enough, as we were talking about, to make sure that we need to get the data, better data on which ones are actually working. I think as you go through the scale from we're a bit worried, which is the websites, to actually you're in or about to go into arrears, that's when the conversations are more useful.
And I think one of the challenges exactly in that statement, in that, you know, we hear Luke mention at the top around former banker and Bank of England announcing UK consumers should see themselves as being poorer. We hear the economic update saying actually in the UK the drawdown on savings isn't happening, and as a CRA we see the data telling us that people are managing the crisis. We're not seeing big spikes in arrears or insolvency, delinquency. So I think the question becomes about what are the right indicators to identify people in a pre-stressed position to drive that conversation, and that's a different mindset to a credit risk policy. That's very much around what's the new solutions available in affordability, how do we see a change in behaviour, and for me it's not a one-size-fits-all. There's a timeline thing here. People are coping, but the question becomes about how long can they lean on those coping mechanisms before there is a financial impact, financial stability changes, and can we be ahead of that conversation to drive the right outcome?
Yeah, absolutely. And so from my perspective, I think it's about embedding, having a long-term strategy around the cost of living crisis. This is not a flash in the pan. And so the data is certainly available. The technology is available. It's about implementing a long-term solution now. We know where the inequalities are, and there is a requirement for all of us to actually be addressing them. And so it's that speed of innovation and sometimes the fear of innovation that prevents the lenders and financial institutions from being able to move forward.
And are we back in a place where you know, the biggest risk is that when you get those indicators that Paul's talking about, the response from lenders is just to reduce availability and say, no, you know.
Yeah, and we've seen, like I said before, we've seen demand grow by 50%. So people are still looking for credit. Nobody's ever going to be excited about looking for credit. Sorry, Credit Summit, but they're not. But what people need to be served, and it's how do we serve those customers, and what data is there available to do that. Whereas what you see is credit worthiness actually maintaining is what we're seeing, but less offers being made to the customers because of the tightening. And it's now time to start thinking, rest in peace, old school segmentation. Let's figure out how to use the data in a more innovative way to suit the customer's circumstances.
Anna, I mean, how do you avoid a spiral now of just people getting in distress, less credit being available, people getting in more distress, nightmare by the end of the year?
I think it's a mix of everything that everyone said here, and I just want to jump back just for 1 second about the things that you were both talking about there, and those coping mechanisms of customers, because what we do know through our work is that there are more customers, and that have savings that have built up from the pandemic, and they're using savings to bolster their everyday living, for example. We know that customers are tapping into products such as buy now, pay later, for example, for everyday essential spending. We know that there is quite an increase in illegal money lending, and so some of these are the coping mechanisms that customers are relying upon. And absolutely, to Emma's point, is we do know that, and you get into that spiral once customers start to use it. The data's there. We can see that there are ways of identifying patterns and trends of customers that are using those coping mechanisms. And so I think it absolutely is about building in these long-term strategies, as Emma suggests, to identify these nuances, these being aware and alive to new coping mechanisms and controls that customers have in place, so that you can identify them early and intervene, and then all of these things help to prevent that spiral.
Just on illegal money lending, I mean, do you believe these figures of more than 1 million people, Emma, now borrowing from illegal money lenders? And do you see that as an opportunity, or do you see those as just basket cases you don't want to go anywhere near?
Well, I think that anybody that is looking for credit, there are always going to be people that you have to say no to. But yeah, you absolutely see there is illegal money lending going on. You know, people are feeling they have no.
But does anybody want to unwind that? If there's 1 million households who are borrowing money illegally, does anybody in your industry want to say, well, why don't we get them into our?
Well, the credit unions are there, right? And credit unions have a real opportunity to be able to grow. It's just that people don't know they exist, really, a lot of the time as well. They don't know where to turn to. And so I think bringing credit unions to the front is something that would be really beneficial there, and something that we're actively working with as well.
And I was just going to say, it's not about sort of finding those customers necessarily that are using illegal money lenders and saying, come here, we're going to lend to you. Yeah. It's about being aware of the customers that are 100% within your customer base that are already using illegal money lending, so that you're able to understand properly what their affordability or creditworthiness is, the commitments that they've already made, the vulnerability, it's a sign of vulnerability, and signposting them to the right support. Because I think as lenders and banks, you're not a one-stop shop to support customers. You can't be experts in every form of vulnerability, and everything. And that's why I think partnership work is so important. You mentioned earlier, linking in with all those different partners, and it is important that we signpost customers where we're able to identify them. Another way of preventing that spiral. And just touching on what you said earlier, Victoria, is as well, signposting is really, really important, but only if it's delivered in the right way, at the right time, that means something to a customer, that enables them to get the support that they need. Otherwise, frankly, it is lost, and we do see room for improvement generally in that space.
Just that one comment there. Do you think the reason data isn't showing customers being under stress is because those suffering greatest have been forced towards illegal lending?
There's a factor of that, because clearly there are volumes of people accessing funds in that way. But more holistically, I think it is a fact that some of that resiliency is still there. I don't think we've seen the end of some of the, stockpiling is the wrong word, but some of that capacity that was built up. And people are, the education is improving. People are really driven to maintain their financial commitment. They understand better the ramifications of it. What we've got to do, though, is ensure that that stretch to maintain those credit commitments isn't having the detrimental effect that, these horrible adverts where you see an elderly lady crying because she's cold in the winter. So I think it's not just about looking at arrears. It's, again, around understanding the financial situation of the consumer. Just take a very simple metric, percentage on disposable expenditure versus committed expenditure. For a large proportion of the UK, that has shifted radically in the last 6 months. It might not be in arrears, but understanding that change in their personal circumstance maybe helps towards counselling and guidance, and as an industry, helping people not take the wrong option through illegal lending.
If I can add to this, actually, I think what we've seen through the pandemic is also not just customers saving more, but also essentially paying down, actually. They're paying down their credit card, they're paying down personal loans. And it hasn't gone back up to where it was before, actually. Most customers, on average, have less debt. And that's so I think that resilience, again, these are averages. You have to be very, very careful about averages, that's for sure, actually. But I think that resilience is still that there's an element of that resilience here.
So is the answer to that question, are you seeing any changes in the profile of customers needing support? For example, people on higher income starting to struggle? No, is it?
I'm going to pick up on mortgage payment because I think this is the one that's going to make a big difference, actually. Because customers, so we have quite a few of our mortgage customers, and we've done some modeling in terms of what we expect to see, actually. And we expect to see those customers who need to refinance will see a big increase in the monthly payment. And those customers are probably a middle, high income, actually. And most of them probably can afford it, but it'll be a big shock. So we expect at least more than 50% to have to pay more than £200 every month, or some of them more than £500 every month. So it is not a small amount of money. On paper, they can afford, actually, but I think they need to help in terms of budgeting, so making some hard choices and support along the way. They need to be told in advance. I think these are the options you have. I think to your point, be ahead of the curve, actually, as much as you possibly
So
can.
what does that mean in terms of, you know, when you say they'll need help? What's the help the big banks like you are going to...
So I think I don't think we have the perfect solution, but I think what we've done, for example, I think we've extended the window that customers can look for a new rate by 6 months. So 6 months ahead of your fixed rate expiry, you can start shopping and get the best rate you can get at the time, and then you can review it a month later, 2 months later, 3 months later. So you're not committed, actually. So but at least you have that certainty and start to budget around. Okay, what does it mean for me as well? We offer.
Is that just because rates are high at the moment? You expect them to go down? Or...
No, people want certainty.
You're hoping people fix now.
No, I think you have the choice, and people do, actually. I think they secure a rate, but I think it's not final until I think the end of the mortgage. Actually, they can get onto another rate. Actually, they can renegotiate, actually, up until the right. But they want that certainty.
Yeah, I think it's about helping the customers want the certainty. I think there's conversations as a bank you can have with customers. And there's conversations, let's be honest, people don't want to have with their bank. They will have elsewhere. We're seeing through spending data, with statistics I saw this week from our spending data, we've got the highest ever spending at low-cost groceries. You've got restaurant spending is going down, takeaway spending is going up. People are seeking themselves. We can't, as a bank, think about going to restaurants less and having takeaways more. But what you can do is make sure that actually we put out information that other people are making these decisions. That's the people are making different spending decisions we go through, but then it's creating the tools that Cyril is talking about within that, the debt products that people have got, making sure that you've got easy availability into your branch network. If you've got one, your contact centres, chat, so you've got a variety of different forums that work for people, particularly with the mental health crisis. People like to interact with banks in different ways. Some people really struggle with face-to-face or telephone conversations and prefer to use chat, and we need to make sure as lenders we've got that variety of channels and variety of availability for people to come to us and talk in a way that is most comfortable for them, and that's actually one of the most important things we're trying to do, is improve and develop some of those alternative channels and availability as we move through.
And there's a lot of talk about data. How reliable is the data that everyone's using?
Well, I don't look at everybody's data, is the first thing to say before I answer that question, before someone chases me off stage. But I think that, we have, and correct me if I'm wrong, we have so much access to data, and that's data that we collect from our customers, and when I say we, the industry, because we don't, from customers themselves. There's data that's accessible from organisations such as yourself. And so I think what's really important is, particularly around this prevention piece that I was saying earlier, is that we're using the information that's available to us, and we're able to make it reflective of what we're trying to understand about the customers at the time, and also the environment that we're working in. So it's making sure that as a result of the cost of living crisis, and as that continues to evolve, we're continuously looking at the data that we are using to make decisions, to identify customers, to make our credit decisioning, for example, and saying, actually, is this the right data? Is there more information from a different source? Or could we look at this in a slightly different way? And we're testing that information. And so therefore testing the outcomes that we're having with customers, and that we're able to do that on that continuous loop to make sure that we are able to evidence that we're achieving the right outcomes for customers.
100% accurate, we would say, but perhaps if not 100%, I think there's a couple of bits. It's also using the data in the right way. You know, we've got policies that have been built up over years and years. It's understanding how they need to change against different data in the current landscape. And the other point I would just add is we've also got a responsibility on the lending side. We're rightly talking about consumers that have financial difficulty and perhaps need extra help. But we also need to make sure that we're enabling lending because it's as critical itself in terms of the economy, the recovery and access to funds. So I think of it, I tend to try and think of the data part of it more in terms of what's the insight it's driving, what's the next best action, and how does that fit in a holistic strategy?
Yeah, absolutely. And I think on the conduct risk side, that is something that lenders talk to us about all the time. And so what we need to be able to do with that data is actually use it to drive the confidence to lend to that customer. And so so the lender feels that they have assurances around that data as well. Whereas right now, what we're seeing is actually the data not being used in the most positive way. Open banking, as you know, I care about open banking a lot. It's a fundamentally positive data set to be able to use, but most lenders, when they're using it at the moment, are actually using it to say no. And so it's about shifting those behaviours and using inclusive data.
Just in the last minute, let's pick up that rather popular question about if you were going to mark the regulator's recent performance out of 10, what would your mark be? Now, I'm assuming this isn't the LSB we're talking about, but...
well, let's hope not. Unless we're all getting 10 out of 10.
But the big one. Victoria?
Gosh, this feels like a career limiting question. I think that, the FCA is very focused on consumer duty, which is massively important. It's been an evolution from DCF. They're doing a good job in difficult circumstances. I think we need to continue to see proactivity and reasonableness. And my question for the FCA when they're here later is, what does substantive compliance mean? Because I think that's something the industry is struggling with, to say, we like the ideas, we're doing our best, but actually we need clarity from you. PRA at the moment, actually, I think I would give them high marks. They're being very sensible, reasonable, proactive, and actually it's not impeding a lot of the things we're trying to do as a responsible lender.
Cyril?
You can't give a mark to regulator, I think it is. We'll get in trouble if you do that.
Isn't that 360-degree appraisal?
Yeah, I think generally, I think we agree, actually. The direction of travel, the intentions are absolutely the right intentions. I think what's tricky for us as well is just the amount of change. I think that's because I think most of that is perfectly reasonable. I think the things we would want to do actually, I think is how much of that needs to get done actually. But I think what we've seen as well is the level of engagement, proactive engagement, and dialogue as well. Actually, I think also was very critical for the pandemic, and that's continued to by and large. I think that's very positive and very helpful.
Paul?
I can't see my legal counsel in the audience. I'm going to go ahead and answer it. There's been a monumental shift. If we don't just think about it in terms of months, we think about it in recent years. The regulator, drives a process in the market without mandating adoption. I think that balance has worked well. I think the industry has adopted the steer that's come away from the regulator. It's a huge challenge. It's being layered now by consumer duty, which I think is the right absolute next focus. So without trying to get brownie points, I think we're in a far healthier position than we were when the last financial crisis came about.
Briefly, Emma.
Completely agree. Let's go.
Okay,
let's go with that.
And do you want to say anything on this? You can't mark a colleague, no.
I can't mark this,
no. Fine. Thank you all very much indeed. Thank you very much, ladies and gentlemen.